Hey, it's Kevin the Credit Crusher here, and today we are coming with another credit tip. Today we're talking about business lending and specifically how to make your business bankable. We're going to talk about the 4 Cs of bankability. So stay tuned. Before we get into that conversation, don't forget to like, follow, share, and subscribe on all of our social media channels. And if you're looking for this and some other great content, some tips and some tools that you can use for your credit, both personal and business, you can check us out on our YouTube channel. It's youtube.com/Premisien Credit Counseling. Please go over there, like, follow, share, and subscribe. Hit the notification bell so that anytime we come up with a new video, you can get the notification and you can see this great content. All right, so let's jump in here and talk about the 4 Cs of business bankability. That's kind of a tongue twister right there. The 4 Cs of business bankability. So we talk about talk to a lot of people and they ask me, well, Kevin, what is it that we need to get a loan from a bank for our business? This is for your business. And I tell them there are 4 C's, and these are universal, so everybody's going to be talking about these. But there are 4 C's in being business bankable, and I'm going to list them for you, and then I'll go into them in detail. So the 4 C's of business bankability are character, capacity, capital, and collateral. I'm going to say it one more time. That's character, capacity, capital, and collateral. So now let me go into each one of those in depth. Your character, the first C, and these are not in any particular order. No one is more important than the other. They just are the order that I'm going to give them to you in today. Character, that means the business owner's ability to pay bills. They're going to be looking at your personal credit, the business owner's personal credit. And when they look at their personal credit, they are looking for a few things. One, they're looking to see that you have no late or missed payments in the last 24 months, sometimes 36, but for the most part, they're looking for late or missed payments within the last 24 months. And so I know a lot of people say, you know, I like to secure lending in my business name, not in my personal name. Well, until you've built your business character, the only thing they have to go on is your personal character. And so that's why, by the way, this is not a shameless plug, but that's why we at Premisien Credit Counseling always, if we are doing someone's business credit, we always do their personal credit service for free, because we know that when you're on the early stages of lending to your business, they're going to be looking at your personal credit to determine whether or not you're bankable. So they're looking at late or missed payments within the last 24 months. They're looking at charge-offs. What they're looking for not only is, if you don't have any charge-offs, that's great. But if you do, they're looking to make sure that there's no owed money on those charge-offs. So if you've got something charged off, you want to make sure you contact the creditor and say, hey, I want to settle this charge-off debt and bring the balance owed to 0. Now, a lot of the charge-offs may not come after you. They may not send you letters. They may not try to collect. But if they show the balance on your credit report, you're going to want to take care of that. Most of the time, you can settle the charge-off accounts for 50 to 70% of what you owe, and that'll bring the balance to 0. Again, it's okay that you have the charge-off, but it needs to be a 0 balance owed. Same thing with collections. It's okay if you have collections. It just needs to show a 0 balance owed. What you ultimately want to do is get those removed. And that's another conversation when we talk in personal side. But for this business credit conversation, I just want to let you know that you want to get the collections removed if you can, but certainly they should show a 0 balance owed, so that when the business lenders look at your personal credit report, they can see that those things have been taken care of. They're okay if you made some mistakes. As long as you settled them and took care of them, that's what they're looking for, because that shows responsibility, that you took responsibility for the loss, and the likelihood is that you'll take responsibility if they incur a loss on the business side. All right? So that's your character. By the way, they don't look at utilization as much, although they will look at your credit limits. So the higher your credit limits on the personal side, the better it is for you on the business side. So what you're going to want to do is every 6 months or so, raise the limits on any credit cards that you have. The higher you get those, and the better it looks. And if I'm giving personal credit advice, which this is not, but if I'm giving personal credit advice, I would tell you do it every 6 months. Don't try to get a new credit card because that's going to mess your credit up a little bit. Instead, try to just continually increase your limits every 6 months. That usually does a soft pull, not a hard pull, and you'll be fine. Okay? So they don't concentrate on those as much, nor do they concentrate on the inquiries as much. They don't really look at those when they're considering. They're really looking at the late or missed payments, charge-offs, and collections. All right, so that's the first C. That's your character. The next C is your capacity. Are you able to repay a loan if we give it to you? And so capacity comes from your income statement or P&L. Income statement and P&L are used interchangeably. So if you hear one, it's synonymous with the other. But income statement, on the income statement, they're looking for really three things. They're looking for your revenue, how much money you generate per year. They're looking, or per month, depending on how they look. So they may have revenue minimums. Some lenders have monthly revenue minimums. They may say you have to generate at least $10,000 per month in revenue. As long as you have that, you fit into one of the programs. And that's determined by them. But they want to know what your revenues are. They're looking for your gross profit, which is your revenues minus your cost of goods sold if you are a product business, or your cost of sales if you are a service business. Your cost of goods sold is what it costs to produce the product that you're selling. So if you're producing sneakers, for example, what are the cost of materials to go into making a sneaker? That's your cost of goods sold. And then your gross profit is your revenue minus your cost of goods, total cost of goods sold. That's your gross profit. In a service-based business, it is what does it take to sell your service? So if you're talking about my business, for example, the only cost of sale is the labor. So we put into whatever it takes for a salesperson to sell our service goes into cost of goods sold. Okay? I'm sorry, cost of sale, not cost of goods sold, cost of sale. All right? So they're looking at your revenue. They're looking at your gross profit, which is your revenue minus your cost of goods sold or cost of sale if you're a service business. And then they're looking at your bottom line, which is your net income or your profit, depending on how you say them. So that is your revenue minus cost of goods sold or cost of sale minus your operating expenses equals your net income or profit, depending on how you want to say it. They're looking at those three things: revenue, gross profit, net profit. Okay? Those things good, you'll be good. And you can get all of those numbers from your income statement. So if you're maintaining good books, you should be able to go right to your income statement and you can see what those numbers are. And they may look for those things expressed in percentages. So they may look for your gross profit expressed as a percentage. They may look at your net profit expressed as a percentage. Of course, the higher all of those numbers are, the better it is for you, the better chances you have to get the loan. So that's capacity. Then we look at capital. That's the assets of your business. What does your business own? And they're really looking at what does your business own versus what your business owes. So if your business owns, let's say you are a manufacturing business manufacturing those sneakers, the assets would be maybe you bought the building. So you own the building plus all of the inventory of sneakers. Those are your assets. And then they're looking at your liabilities. And what they're really looking at is a ratio. They want to know what your debt to asset ratio is, or vice versa, what your asset to debt ratio is. But let's say debt to asset ratio. So you want that to be you don't want that to be a one-to-one relationship. That means what I mean by that is you don't want to have a $1 debt to $1 asset ratio. So you add up all of your assets, you get a dollar amount of the value of those assets. You add up all of your total liabilities, not the monthly, but the total liabilities that you owe. And then you take those liabilities, you divide them by those assets. And if you get a 1-to-1 ratio, not good. If you get a 1-to-2 ratio, that means for every $1 of liability, you have $2 worth of the value of assets. That's good. And any number above that is great. That says that you have way more assets than you have liabilities, and that looks good. You get those numbers from your balance sheet. Look at your balance sheet. You can look at your assets, total them up. You can look at your liabilities, total them up. And then you can divide your liabilities by your assets, and you can see what that ratio is. Good ratio is 1 to 2 or higher. Okay. And that's debt to asset ratio. Okay. The final C is collateral. And collateral and capital might be confused, because collateral is also assets. But collateral is assets that you can give to them, or you can surrender to the company should you not be able to pay back the debt. Going back to our sneaker example, so you own the building, you own the inventory, but you're probably not going to put up the building and the inventory as collateral, because you need the building and you need the inventory to make money. So you don't want to surrender that, because if you don't pay back that debt, they're going to take the building, and you don't have a building to make those sneakers in, then you can't make those sneakers. And if they take the sneakers and the building, you definitely have nothing to sell. So, but maybe the company owns trucks. Maybe the company owns other real estate assets, and they can surrender those real estate assets. Maybe the building owns maybe the company owns a building where the employees work, and they can just move employees into another office if they have several of those buildings. So you're going to want to put up collateral that you don't mind losing, that don't stop your operations if you default on the loan. Now, in small business, we're not talking about those things as much. In small business, you're talking about, when we talk about collateral, maybe the business owns some intellectual property that you're willing to put up as capital. Or maybe the business owns some piece of residential real estate that you're willing to put up as capital. Maybe the business owner owns some residential real estate that you're willing to put up. It's usually on a smaller scale. But the bank they're going to hope that you have collateral. If you don't, they can still work around those things, but they're going to hope that you want collateral. Now, we've talked about the 4 C's. Each one of them is important. You want to have each one of them in place, but not all of them are going to be in place. But you're going to have to get real creative in lending and lending sources if you don't have all of the 4 C's in place. If you do, great, you're in a better position. But if you don't have collateral, or you don't have a lot of capital because you're starting out, or your revenue is not what a bank wants, or the monthly revenue doesn't equal what their revenue minimums are, then you're just going to have to go to other lenders. That is why these 4 C's are why a lot of people in their small business get investments instead of take on debt or try to finance the business through a loan, because you don't have those 4 C's, and an investor is looking at profitability or the increase in value of your business with this injection of capital so that you can get some of these assets. So the 4 C's of being business bankable, 4 C's of business bankability: character, capacity, capital, and collateral. All right. Again, like, follow, share, and subscribe on this and all the platforms that we're on. If you are looking for more content, please go to our YouTube channel, youtube.com/Premisien Credit Counseling. Hit that notification bell, and we've got some more content coming from you. Stay tuned until next time when I come with another credit tip.